I wanted to sort of ask a bit of a related question, which is how might rental real estate change things? If you have a rental property that produces the equivalent of 1%, 2%, 3%, whatever, of after-tax withdrawal income that essentially serves as the dividend portion of your portfolio, or that contributes 1 or 2 points to your annual withdrawal rate, then how might that alter your asset allocation and safe withdrawal strategy? Does it make it more compelling to hold an all stock portfolio? Does it potentially even make a glide path strategy irrelevant, and under what conditions?
Yeah, so again, if you believe that you hold a real estate portfolio where the dividend income is relatively stable, and then also the principal of that portfolio is relatively stable, and so then yeah, you could argue that this is something that will aid you in your withdrawal exercise, right? So my wife and I, we definitely thought about buying our own rental properties. We've always pushed back because we have some other routes to do that. We invest in uh, real estate through some private equity funds. So you basically just become a shareholder in an LLC. I have absolutely no power. I mean, that money is totally out of my control, out of my hands. They can basically do whatever they want with it. So there's definitely a trust issue there that you only want to do that with some trusted players. And yeah, so I mean, so far I'm happy with the returns, right? I mean, they invest in real estate. They do multifamily. They have relatively stable rental income. There's a little bit of a hiccup, obviously, right now because there is some properties where you have some rental delinquency. I don't think that the delinquency rate is at any worrisome level, but it's definitely higher than before. So I so uh, rental real estate again potentially also suffers a little bit from this all else equal fallacy, right? So I have it's kind of hard to model how is your rental real estate income going to behave over the business cycle, right? If we have another bad recession, it's hard to model that, and because it's hard to model, let's not model it at all. That's obviously the fallacy that some people might commit there. And so it's definitely the danger is that you think that you have this very stable rental income that will hedge the sequence risk in your equity portfolio. But I mean, keep in mind that definitely your rental portfolio could also take a hit during a bad bear market. I mean, the nice thing is that again, doing the background check on some of the private equity providers that we invest with. Well, I mean, you ask them, well, for how long have you been doing this, and how did you do in 2008, 2007, 8, and 9? And they actually have very good returns during that time because if you were in the multifamily business during 2007, 8, and 9, and you were cautious enough uh, to not buy at the peak and not being forced to sell at the bottom. So if you could make it through it, you didn't have any cash flow problems where you couldn't make your because they're also leveraged plays, right? I mean, they have some mortgages on these properties. If they were cautious enough that they never had any cash flow problems where they had to sell an underwater asset because they couldn't make the mortgage payments at the bottom of the market. If they all made fantastic returns. I mean, if you bought some multifamily properties before the global financial crisis, remember a lot of uh, everything in the real estate sector definitely took a hit if you just look at the price returns, including multifamily. But remember, the ground zero of of the global financial crisis was the single family market where they were flipping houses, they were leveraging up their own private residences up the wazoo, and the people that lost their houses, well, they had to move somewhere. Well, where did they move? They moved to multifamily complexes. So it's actually some of the worst effects of the rental market at that time. The multifamily sector was a little bit spared from that. Maybe not everywhere. Probably in Las Vegas or Miami, they also took a hit. But if you were reasonably diversified and you knew what you were doing, you could do relatively well, even in 2008 and 9 in that market. So that's why we have so far stuck with that little niche of the rental real estate. There's obviously also some drawbacks, right? I mean, I'm probably preparing for some of the cash flows to be a little bit lower over the next few years, right? To hold back some income and put some cash reserves on the side to deal with delinquencies. But yeah, I mean, I definitely think that it's a good asset, and it's a good diversifier, because there is a correlation with the stock market. Everybody who ignores this is really treading into really dangerous territory if you assume that in your safe withdrawal analysis there's absolutely zero correlation with the stock market. But I mean, as long as it's not 100% correlation, if it's only say a 0.5 correlation with the stock market returns, I think it's definitely a very good diversifying asset, especially if you look at, well, what other assets do you have as a diversifier for stocks? Right, you have the bond market, where treasuries pay less than 1% as of mid-December when we're recording this, and yeah, you have a rental real estate that has a net operating income of somewhere so unleveraged has a operating income of, I don't know, something like 5, 6, 7% or so, and then you lever that up a little bit. That definitely looks like a very attractive asset class. And again, I mean,
does it alter the glide path,
oh yeah,
sort of strategy? Does it mean that I can be less conservative in my bond
yes,
tent, for example?
yes. I mean, yeah, I would definitely support that. So because if half of your retirement expenses are coming in from your rental portfolio, and the other half from your other paper asset investment portfolio, and you have some confidence that that rental portfolio is appropriately diversified. You don't, because imagine, yeah, you think you have 10 different rental properties, but they're all in one city and they're all relying on that local economy. That I would probably be a little bit more careful. But I mean, I think the way that we structure it, so we have 4 different private equity funds where we invested, and I would like to invest in more as they come out. And but each fund itself is also diversified over multiple properties. So it's not just one property. It's not like one of these crowd funded platforms where you basically fund one specific property. So the minimum investment is a little bit higher. It's between $100,000 and $250,000. But then each one of the funds is also probably somewhere around 10 properties, right? And each property is anywhere between 70 and a 200 unit property. I think one of them is over 500 doors. And so there's enough diversification across different tenants, right? If there's always some delinquency, there's always somebody late with the rent, but you diversify it over enough units, and then each property is in a different location, and there's some diversification, some geographic diversification. So I definitely like that idea, but again, make no mistake, right? If something were to go bad, they will stop paying dividends, right? They will say, well, you know what? I mean, we have to preserve the cash flow, and we stop paying dividends. So, I mean, each individual fund itself, I would not invest so much money in there that I say, you know, I give you the money, but I really need the dividend income every quarter. I definitely, I'm risk averse enough, and I'm also, I think, realistic enough that I would not invest in one single fund so much money that I would get into cash flow problem myself. And again, I think that even if there is a problem, I think eventually, if you look at the total internal rate of return over the entire length of the fund, it's still going to be a very attractive return. But keep in mind that there's this illiquidity, right? You cannot sell the share. You cannot get more money out than what they pay you as dividends. And it's only when all the final tally is all done after maybe 10 years, when they wind down the entire fund, that's when you know your final internal rate of return. But I mean, obviously, I've invested with some of these companies that have gone through multiple market cycles, and they showed me the IRRs that they generated. It definitely looked very attractive. Even the ones that spanned the global financial crisis or the dot-com crash, there's definitely something about real estate, right? Because it's stock picking probably doesn't work so well, right? Because there's only about 5,000 corporations in the US that are really in one of the big indexes, maybe 500 that are reasonably liquid, and everybody's trying to do the same thing. So stock picking is pretty much arbitraged away in that sense, or largely arbitraged away. But in the real estate sector, if there's definitely something about picking and the illiquidity, the how broad the market is, how many small properties there are, where not everybody can do the same kind of analysis. There's some off-market transactions that
more possibility for alpha, I guess.
There's more a possibility for alpha. I mean, for example, I've heard one person tell me that, look, I mean, if you're looking for a rental property, the MLS is a non-starter, right? Everything that comes out on the MLS as a rental property is bid up so high that you'll have trouble making a lot of money. So you really need to you need to get your hands dirty and try to find a property off market. And funny thing is, he said that, well, you know what, he knows people who are very good at finding properties off market. And then what they did is they actually specialized in, well, you know what, after they do that, they don't even want to buy the property and fix it up and rent it out. They're going to sell that. They get a finder's fee and then they sell it to somebody. So this is how specialized the market has already gotten in the rental space. So you can't go off of the MLS, right? If you go off the MLS, probably rental yield is going to be really crummy, right? You have to find the property yourself, or you have to pay a finder's fee to somebody who finds a property for you off market, right? Where they put flyers into people's mailboxes, say, hey, we want to buy your house, where they want to operate on some kind of the off chance that, well, very, very macabre, right? I mean, they go through the death notices in the newspapers, and then they go to these properties. How sad is that, right? I mean, they say there's a death in the family.
Oh yeah, no, it's
and then there are 17 people in front of your house, and you get flyers. Hey, if you want to sell your uncle's house or your grandpa's house, we're going to give you cash really quick. No need to fix up the house. How sad is that? But this is how these
oh yeah, no, there's definitely
wholesalers work.
There's software now that helps you do that.
Yes. It's very sad and very macabre, and which is probably one of the reasons why I don't want to get into that kind of the business. So because the private equity funds that we work, I mean, they do the same thing, right? They don't buy stuff off the MLS.
I imagine the properties aren't even listed
off market transactions, or they find a plot of land where nobody ever was able to develop anything, and they found a way to do that. So these guys, there's some very smart people. And of course, you have to pay them a management fee. I think they take something like 1% or 2% of your investment as management fee every year. But the nice thing about the private equity route is that even with that 1% or 2%, they're not going to get rich off of that, right? They have a huge incentive to manage this well, pay out the dividends and the rental income to the investors, and then there's a certain order of who gets paid first from what, right? So the
Right.
rental income, so the
Right.
investors get paid first before the managers get paid. And then the same thing with the capital gains. There's a first certain tranche. So the first X percent, the investor gets 80%, the manager gets 20%. And if you go above a certain tranche, then it's 50-50 in terms of the
Right.
capital gains. And these guys have a huge incentive to do really well, find good deals, because they get very, very rich off of that
Mhm.
final split where they get half the capital gains. When
Right.
when the investors already get paid very, very richly, but this is how these people, they have
Yeah.
boats and vacation homes. They got it off of that 50% split in the end.
All right. So I just want to ask one more question. I know we're like running really late on time here, but
Yeah.
uh, I wanted to ask about the crossover point of when sequence risk,
Right.
how one can analyze when sequence risk disappears. And what I wanted to ask is, if we think about early retirement, basically as, up to 30-year retirements back to back, and the crossover point being where the retiree is virtually guaranteed not to outlive their savings. What dependable heuristics can we use to analyze? For example, can we assert things like, if you still have X% of your portfolio remaining and you're already Y% of the way through your
Yeah.
expected retirement or even lifespan, then you're virtually guaranteed to outlive your savings. And in particular, what I wanted to know is there a way a retiree can sort of visualize the plotted curve of the relationship between that X and Y, so that they can analyze questions like, given that I'm 10% of the way through retirement, what does my portfolio need to be out of the woods? Or given that I only have 80% of my original starting portfolio left, how far along my retirement horizon do I need to be out of the woods? Is there a way that folks can visualize these
Yeah.
kind of relationships?
Yeah. So I think I wrote a blog post about that. And the blog post is called "When Can We Stop Worrying About Sequence Risk?" Right. And basically what you could do is you could look at what are the fail-safe withdrawal rates, looking at 5 years horizon, 10 years horizon, 15 years horizon. Well, if you want to do more granular than that, you can do that too. But I think I did it in 5-year steps. And I looked at, so imagine you want to withdraw X every year. How much money do I need at different stages during my retirement to, at least in historical simulations, you never run out of money. So even if 17 years into retirement, you have a certain amount of X, you withdraw Y. And so what has to be the multiple between X and Y, so that even if we have another Great Depression, you will never run out of money over the next 17 years, right? That's the question you ask. And yeah, I mean, you could plot that. And I think I did that in one of the charts. And yeah, I mean, it's basically a function that starts relatively flat, right? If you go from 30 years to 28 years, you pretty much need exactly the same amount as before, right? Maybe a little bit less. And then as you get closer and closer to maybe, I guess, between 15 and 10 years, that's when it starts really bending down. And then you need absolutely much, much, much less than 25x or 30x. And yeah, I mean, I think that's a good exercise. So I did that exercise. And then, for example, if you start with the retirement of, say, 60 years, yeah, I mean, there's going from 60 years to 55 to 50 years. There's really very little movement in that number. So so in that sense, again, it depends on how you define sequence risk, right? If you say, look, I have a certain budget, and if my portfolio does much better than what I feared, and I still have the same budget. I mean, this is a little bit our situation, because we retired in 2018. We did a relatively conservative withdrawal amount at that time, and our portfolio has grown substantially since 2018 until now. In fact, even at the bottom of the 2020 bear market, we still had more money, more net worth than when we retired. So this is why, for example, I was not too worried about that particular market drop. But now we are, so yeah, I would say that we are totally safe from sequence of return risk, because if we budget the same budget as before, we have so much more money, which at the time of retirement was already kind of conservative. So now our safe withdrawal rate, basically what you could do is you could check, well, what is your current safe withdrawal rate? So you look at what is your budget divided by your current portfolio. And has that ever failed in historical simulations? We are so far away, even from the Great Depression, that I guess I could completely discard sequence of returns. Now, of course, in one way, and this was my one of the conclusions from that blog post. If you are rational, you could say that because our portfolio is up by, I think it's probably up by something like, maybe not 50%, but it's not quite 50%. Let's make it a round number. Let's make it 50%. So our net worth has grown by 50%. Should we now increase our withdrawals by 50%, right? So you re-normalize our retirement, where you say that, well, imagine I had just left work yesterday and now I start retirement and I look at today's portfolio. How much of a safe withdrawal rate should I apply to that? And of course, that would give me a higher retirement budget. If I do that and I ratchet up my living standards, well, now I have basically reinitiated sequence risk again.
Yeah.
Because now I have instead of a 50-year horizon, I have a 48-year horizon. But again, between the 50 and 48, that's not that big of a difference. So now I have sequence risk again. So in that sense, you will never run out of sequence risk until you're basically 1 month before you die. And then you have no longer sequence risk, which is a bit of a sad and defeatist conclusion in that sense. But again, keep in mind the reason why sequence risk will be always with you is that, you always, there will always be sequence risk. And even today, we have sequence risk in the following sense. So we have the risk of probably never run out of money. But of course, we face the sequence risk between, if we have good sequence, if we have a good sequence of return, we will die with some absolutely astronomical pile of money, right? Or if we have bad sequence risk, we will probably still preserve our capital. So it's something like between, in a good outcome over the next 50 years, we could grow our portfolio to way into the double-digit millions. Versus in a not so good, we just preserve our capital and we only die high net worth. And in a really good sequence of return, we're going to die as not just high net worth, but probably in the ultra high net worth category. So in that sense, there is still sequence risk. Of course, it's a sequence risk between astronomical portfolio versus still multi-million portfolio. So in that sense, you never run out of sequence risk. But again, if you think about it, when do you no longer have to worry about running out of money? Mm-hmm. That's a different calculation. Then you can say, even 2 years into retirement, you can say, well, we'll never run out of money now.
That's an interesting point. I guess send me the link to that blog post. I'll definitely link to that in the show notes as well. I think that'd be really useful. And I think what I'm taking away is like, yes, there is this relationship, which folks can read more about in your blog post, but also if your withdrawals, if your budget is all you need to like survive is already so low compared to of a withdrawal rate compared to your portfolio, then that sequence risk, at least for purposes as defined by not running out of money before you die, might be very short. It might disappear within a couple of years, or it might have never even existed at all. It just really depends on the size of your portfolio. Mm-hmm. If your budget withdrawals were only like 1% of your portfolio, 2% of your portfolio, right, you effectively have eliminated sequence risk even from the very beginning.
Right. Yep.
Gotcha.
Yep.
All right. Well, Karsten, this has been super insightful as always. I've loved our conversation. I'm probably going to break this up into multiple episodes.
Yeah.
There's so much meat here. Where can folks find out more about you, your work, what you're up to?
Oh, same as last time. So I blog at earlyretirementnow.com, and this is where I'm most active. I don't really People sometimes send me messages on Twitter or Facebook, and then I find them about a month later. So it's always better to, if you want to reach out to me, go via my blog. And yeah, I mean, we're enjoying early retirement here. We have a 7-year-old daughter. We do the homeschooling slash doing the Zoom meetings with her teacher every day, but you still have to monitor that. So we're busy with that. And then I'm busy with a few other projects here and there. But yeah, so enjoying our early retirement, very quiet and relaxed time. And so yeah, if you want to reach out to me, you'll know where to find me, earlyretirementnow.com.
All right. Well, I will definitely link to that, the blog post, the cash flow model that we talked about in the show notes, and look forward to sharing this with everybody. Thank you so much again for taking the time to chat with me. It's been real fun, as it always is.
You bet. It was always good to talk to you.
Take care. Bye-bye.
Take care.